All right, good morning, good morning. It looks like Zoom is going to be cutting 1,300 jobs. That's about 15% of its workforce. So it just adds to the list of tech companies shedding some weight, cutting costs by cutting workforce. We have a lot of Fed speakers on the agenda today, not really a whole lot of economic data. We do have inventories, which has more anticipated impact, in my opinion, than what we're seeing here. It shows on FX Street that the inventories will be a light impact, which statistically or on average, I'm sure that's true. Right now, we're still going through that whole situation where during the 2020, 2021 recovery, when managers couldn't get their hands on anything and were over ordering everything, and then they ended up with massive supplies of overstock in a lot of areas. So inventories do matter. They've been a big part of what we saw with Walmart and Target last year, and kind of interesting to see how they do through the year this year. But just for an example, right? Just hearing those two iconic names. Other than that, we have a whole lot of Fed speakers today. The anticipation is they're all going to sing from the same hymn book, speaking the same phrases, sentences. Of course, they're all going to try to be independent and show that they think for themselves, but at the end of the day, there's a message that they need to get across. This is a part of that new program where they are trying to improve their messaging. So we'll see how well they do at that and see what message it is that they're trying to beat into the market. Powell yesterday came out hawkish, and yet the market just continued as though he was not. And it was basically on the disinflation comment that he had made. If you kind of go back and see what Bloomberg's 5 things you need to know, they talked about Powell in the first part of it. So even though Powell was hawkish, that comment about disinflation beginning was the match that lit the fire. And we're down this morning 0.25%, so it's not like it's a runaway freight train. Not now, anyway. So volumes coming in, a little light, but nothing too extreme. 97, it's less than 100. Without really having a lot of Econ on deck today, it's a little attention getting that it's below 100, but really not that bad. So at 10:30 today, we get the petroleum status report. This is a big deal. We've seen a turnaround in energy yesterday, and it's still going. The idea was that we were very likely going to see a rally into resistance with energy, and it's still going strong. And then we have the 10-year auction, which is a big deal. It's one of the bigger ones you want to keep track of. So yesterday we talked about how WTI had broken underneath the trend line and was rallying up into the bottom of it, right? So it was rallying into resistance, while crude, on the other hand, had wicked through the trend line but had closed above it. And now both of these markets are back on the march, back on the move to the upside. So we've still got 87 as a cap in Brent and 82 in WTI, and it's all still a part of this basing pattern at the moment, right? We wouldn't want to get all bulled up and try to take long yet, other than just, you know, say a short duration, very minor term trade. Bigger picture, if we're on the weekly chart, you can see a trend line breakover is setting up a TRB. That's a weekly TRB. Would have a really nice follow through, $100 and then 115 on the way up, right? But you got to get that breakover first. Otherwise, if you get in early, you're just hoping. Hoping is a really bad strategy. Either way, the follow through in energy was kind of impressive. You know, it must not have got the memo that it was supposed to stop at the trend line. Yeah, I mean, you could look at energy stocks, right? When you maybe Thinkorswim has a list for it. Otherwise, I think you'd have to scan for it, right? But if you go to public, you can go to industry and energy, and then from energy, you can go to oil. I was specifically talking about oil, right? So, not say energy itself. So when you get into oil itself, you got exploration, mining and production, refining, transportation, storage. I tend to focus on like gasoline, crude, and then the Brent, like price of oil per barrel, the product itself. If you did start getting into the companies like Halliburton, you know, it's not a bad way to go. The thing about the companies is they're going to respond to the stock market, right? So say when we were really deep in that bear market and everything was going down except energy, we've seen a lot of energy companies going down because as a stock market, those stock companies were going down with the rest of the companies, even though energy was going up. So it's tricky to play energy, right? Because the broader market can weigh on the sentiment of the individual energy company and keep that company down, while energy itself, oil and crude and coal and gas and whatever, can continue to go up. It's just tricky and confusing. So I tend to lean more into the ETFs and into the product itself, unless I'm specifically taking a trade on an individual name like Valero, Halliburton. Yeah, you know, like one of those. All right, so after a very large, expansive move, we're inside of it now. And basically, we're in the same spot as we were Friday. So after all of this, we're still right where we were. Friday's close is 41.46. And we're at 41.62. So a whole lot of running around, and we haven't gone anywhere. We haven't accomplished anything. And as I was talking about yesterday with that indicator, the Laguerre, sitting sideways like this, we're going to start building up more gamma again. We're bullish on the daily. See, it's magnetized across the top. And as we're sitting in this sideways posture, we are rebuilding energy levels, preparing for another move. We have an MDP at the moment. That's a missed daily pivot. It's not my strategy, but it's very easy to find material on it. I bring it up because even though I don't trade that strategy myself, the strategy is offers real insight into an approach on the market on a day-to-day basis. And one thing I hear people say a lot is, well, I don't really know how to do technical analysis. I get it, right? It's not like there's some really great book that says, everything you need to know about technical analysis, read this book. It's kind of a sum of parts. You pick up a little bit from different places. What it means to have a missed daily pivot and what we have as an expectation for the market movement because of it provides insight. So it's worth learning the strategy, even if you don't want to trade it. I don't want to trade it. I have no intentions of trading the MDP. Today, as in every single day, there's three things that we can do: break out of the top, stay range bound, or break out of the bottom. The likelihood that we're going to break out of the bottom is the least likely scenario today. Not because we're bullish, but because the bottom is so far away. So it's not to say that we can't get there, but it's an entire ADR distance away. So the ADR today is 1.5. To get to yesterday's low would be 4103 as a full ADR, and the low is 4098. So they're 5 points away from each other. We could move there, but we would kind of need to have a bearish reason to go there, right? Not being bullish doesn't automatically make us bearish. It just kind of leaves us sitting in neutral. The market completely ignored Powell yesterday, or selectively chose to listen to him, I guess is a better way, because they heard his disinflation comment. They just completely ignored the rest of it. Selective hearing. And, we kind of want to see that follow through. So for an opportunity to trade today, and it's very likely not going to be just in the S&P, but across the board in a lot of the names that we are going to go look at, we're going to need this breakout. Without that breakout, we're just sitting range bound. Most of the market is very likely going to be range bound too. This is a part of that won't break through logic, right? Ain't gonna. I tend to name my strategies in trade logic and concepts. One, it makes it easy to journal, but two, it keeps the concepts simple, because there's no reason to overly complicate things just to sound smart. Things are complicated enough as they are. Ain't gonna kind of fits into it ain't gonna break out, right? Or if it was already going down, it ain't gonna continue to go down. Ain't gonna. Now, it could break out. It's one of the three things that it could do. But where's the push for that? It already made a big move yesterday, and then it reset it all, and then it made the big move again. We're underneath all of that now. If you think about the liquidity vacuum, the first one, the second one, and then closing it back up again. We need a catalyst. So an inside day breakout to the upside would very likely need to come at the expense of something, some news, an earnings by a good sized company, an earnings report by a popular CEO who has something to say, some catalyst to galvanize us and break us through to the upside. Otherwise, we are still holding above that 50% mark, which is still our line in the sand. And as long as we're holding above that, we have the capacity or the opportunity to become bullish. Just not today. Remember, we got quite a bit of ways from the 10, and we've kind of faded back or pulled back now. So we're on the weekly. That blue line is the 10. You can see we haven't reset yet. We kind of came back towards that 10 last week, but we didn't get back to it all the way. And now we're moving farther away from it again. Yesterday we hit that 10, so we had our reset. If we can get outside of today's candle, then we have to challenge February 2nd, which has a lot of liquidity up there. This is the trapped traders after the FOMC event. We get above that, we have a gap to fill at 42, call it 42.30. So got a lot of stuff up there. Yesterday, I gave the range of 4,100 to 4,200. It's not a bad thing to stick to if you're looking for some swing trades that we would really need to get out of that range. If you're looking for a market to actually move somewhere for, say, directional swing trades. $10-day, 30-minute volume profile. It is getting more narrow through the day. Today, we should lose the rest of this 39.50 candle prints, and we will then be dealing with a volume profile that goes from 4,000 to 4,200 to be a much more narrow 200-point profile. We've managed to sustain ourselves above that air pocket. It's not a very big pocket anyways. If we do break below 40, call it 4,100, going to 40.65 to the point of control seems like it would be inevitable. So that'd be the target. We still don't have a classic shape yet. We still got this chewed bubblegum look. Really doesn't have any real shape to it. We ran through the VPOC yesterday like it wasn't even there. It was during the POW comments, but we now have a VPOC from yesterday, so we'll just steal the line and move it down. That's 2 below us, 1 above us. Excuse me, 3 below us. So a break to the downside, 41.11 or 41.12 is close enough. Be a cog line, center of gravity. So if we get close to it, we're going to it. Otherwise, that 41.90, 4,200 area, if we do make a break to the upside, it's going to be a real challenge to get through that zone. We don't have that VPOC up here anymore. I took it off because we did wick through it, but I really don't feel like that liquidity has been resolved yet. We are 1% away from the 10-day, and that's not very far at all. We're more than 3.25% away from the 10-week, kind of equal with the last print. We still need to be on watch today as if this is going to begin increasing again, which isn't unheard of. It's just not the norm, right? Normally we roll over and it makes like a little curve shape, coming back towards the 10 and then leaving and going farther away again without having first reset. I mean, it's possible, but statistically it's not the norm. So we got to watch it for the follow through. If you look at where we are on the week in relation to the weekly expected move, I mentioned it a little bit earlier. That gray line is where we closed last Friday. So Monday, Tuesday, here we are Wednesday, a whole lot of running around. We're right back where we started. We haven't done anything yet. Inside week 100%. And although it is a very steep move here on the underside, if you're looking for a solid short, you'd really want to break that trend line. And we still don't have a solid close above 4,200. I did mention when we got above it with, when we wicked through it on the week, but we need a definitive solid print above. And it was something interesting that I was reading about on Bloomberg, where they kind of made a point to say that there are so many conflicting analysts right now who have years and years of background on the particular thing that they're pointing out. Right. So say when the Fed cuts or when the Fed pauses, what happens afterwards? And then there's another analyst that says, oh, look how steep the yield curve is, the 210 curve. It's way down here and historically, blah, blah, blah. And a lot of these are all conflicting right now. And it's not to say that the person who's bringing it up is wrong. It's that things are so screwed up right now that there are like 4 or 5 major analysis point of views out there that are all contradictory, and they're all historically, they all have historical precedent and they fit the current scenario. So it's like, well, should we be bullish then or bearish? And that's the dichotomy that's going on right now, where we've got a marketplace that's crazy bullish and yet bearish at the same time. It makes absolutely no sense. The volatility tools are trash. There was an article that came out about the SPX options yet again having their volatility increased by 100% on the front end. It didn't happen in a single day, but if you're trading the front end options, they're just a lot more volatile now. And to even try to identify a gamma squeeze, instead of looking at 200% above average options volume or volatility, we would need a volatility level even greater than that, right? Double that to like 400. So you'd have to change your sizzle metrics if you're going to be using the Thinkorswim sizzle, so that you're not defining things by 200% anymore. You're defining them by 400%. So it was a good read, and they just barely touched on it. There was another article that brought it out in greater detail, how right now typically there's a theme going on, right? This theme usually is something like we're in a disinflationary state, or we're in an inflationary state, or there's this thing, and then the market latches onto it, and that's the narrative that we all carry for a while, and then we get a new theme and we get a new narrative. Well, right now there's so many conflicting narratives that there really is no thing to latch onto. And that is what is driving a lot of this chaos, where we're getting these really big moves and differing market directions. When I talk about consistent, persistent price action, it usually defines a logic that says when everybody's doing the same thing, you can't miss it. So when the market runs nonstop in a single direction, for an example, you know that there's absolutely nobody going in the other direction. There's only a little bit of profit taking and everybody's buying, for an example. When everybody's doing the same thing, the market is really easy to analyze. It's really easy to trade. And I hate the word easy in trading, but definitively speaking, it's about as good as you can get. When you don't have that, and you have conflicting narratives or conflicting concepts going on, you have conflicting price action. Nothing sticks. So someone in the chat just nailed it perfectly. The technical analysis is bullish, but the fundamental analysis is bearish and conflicting. Yeah, we just again this morning seen another company lay off 15% of its workforce. And yet, if you look at the job numbers, all the big companies that's been laying people off, they found work. They didn't hit the rosters of unemployment. So there's the point of it is don't give up. If you're kind of new to trading and you think that this is all really, really hard to do, and it is, but right now it's more hard than normal, right? So you picked a bad time to start, but don't give up. Look for those days or those weeks where we have a real solid narrative where everybody out there is all looking at the same thing, talking about the same thing, focused on the same thing, and you'll see a market respond that way, and it'll be a much easier market to trade. Unfortunately, it just requires patience, waiting for that opportunity. And, there's days where it just seems like it's not ever going to come. We are wound up, ready to go. I do think that if we do begin breaking to the downside, we have to get below that 50% mark that I drew, right? So we're looking at 4,100, good clean line in the sand. We have to get below that. Otherwise, if we're headed to the downside, that's where I expect to stop. It's where the bounce would be. And until it breaks through it and proves it to me, if we get down into that area, I'm very likely going to go long again. I have no expectations that we're actually going to be able to get above and stick 4,200 without some news today. Nothing in the news should be strong enough to push us up there. So it would have to come from one of those Fed speakers is really the only thing that I could see, or some news, right? News could come out and push us through, but we can't forecast news. So one of the Fed speakers, chipping teeth, would be just about the only thing that I could see that could galvanize us and break us through that level. Nat gas continues to not find support. So a nice little basing 2 days down here on these lows. It started to work its way back up, hit resistance already. Now it needs to keep it. Since we've now left that 8.2 area, and definitely the low here at 8, we really need to hold above 8. Now, classic double bottom says that we could revisit 8. Right? If we think about a classic double bottom, we could revisit 8. And the way IBD talks about double bottoms is it's a really good double bottom if it goes lower than the previous low first and then runs. So it doesn't mean that we can't go up if we don't do that little pattern right there, but I'd like it better. If you're looking for an opportunity to go long in this, it's not ready yet, right? We basically rallied right into resistance at 889. We're very likely going to digest down in this low for a while. It's hard to imagine that we're going to V-bottom, right? I mean, it could be a shape like this, kind of a classic reversal. But considering how much room we have to travel back up, there's absolutely nothing wrong with waiting, right? You don't have to get in right away. And if you were going to wait, one of the things that you could wait for is something really simple, like just getting above the 10. Closing above the 10 on a week, or looking at it on a daily chart, seeing the daily candle close above the 10, and then ending the week staying above it. That way you don't think I mean going to a weekly chart and getting above the 10, which is a completely different thing. No rush on it, right? But it is down this morning. KWeb is down, which is our representation of China internet companies, but also emerging markets, which is another representation of mostly China names, is up this morning. So a little bit of divergence between those two. Bitcoin is down. Financials, communications. Solar is up the most this morning, TAN, which is a solar ETF, 250% or 2.5%, excuse me. 250. I think I'd be freaking out if it was 250. So 84 has proved to be resilient. Any move here in TAN, we really got to consider that 84 as a stopping point. All right, we're sitting at around 82 now, pretty close to it, 80, 81 and a quarter. So not a lot of room left before we hit our head. Nice J hook with a full gamma. That played out well. All right, the flow is bullish this morning. It's not a lot of flow yet. Obviously, we're still in the pre. But if we were looking at minus 90 versus 90, the minus 90 had one name in it. The 90 had all of these. So that's a good start. All right, 5% of the S&P is up 1%. That's nothing. So let's bring it into a 0.5%. S&P, only 6% of the S&P is up 0.5%. And again, that's nothing. Taken in the other direction, down. 11% of the S&P is down 0.5%. We're just really, really flat across the board, which is what I mentioned at the start of the briefing, is if the S&P is sideways, we're very likely going to be sideways all over the place. And that's not to say you won't find a diamond or, a rare gem, something that's moving where the rest of them ain't. But it's usually going to be because that particular thing has a reason to run. News, widget, product, something. %17% of the NASDAQ is down 0.5%. It's kind of scattered all over the place. I see JD is on there. It's one of the China ADRs. What I don't see a lot of its peers. Baba, Baidu, PDD. So we're looking at here is the S&P 500, but we really don't want 500 names, and it doesn't give me a chance to look at the S&P 100. So we filter it by market cap. That way we're still only seeing roughly 100 names. They are gray unless they've moved a 0.5% up or down, and then they get a color change. So before I adjust that, we really want to see what stands out. Google down 1% while Microsoft is up more than 1%. These two are battling it out right now over AI search, AI software, AI tools. Google has been developing those AI tools now since 2017. They've got fully formed, ready to go, ready to run, fully back tested and ready apps and websites and tools that they just haven't brought out. They've just kept them in their pocket and continued to perfect them and clean them up and, tweak them slightly. Whereas Microsoft has been really the splash in the pool in the last month with their Chat GPT purchase, and then yesterday coming out with AI built into their Bing search engine, which is like the worst search engine. I never use it. I hate it. Bing sucks. They both had events yesterday. Google apparently wasn't as well received as Microsoft. And then we have NVIDIA. Those three are a part of the monsters of tech and completely divergent. Apple, not even playing the game at all, hasn't even moved a 0.5%. Amazon as well, another monster of tech. And Tesla, another one. Meta, they're just not in the game, right? And then we've got these two powerhouses battling it out. When I do make the adjustment to the color scheme, I think that kind of tells the story right there. And when I first started and I would look at these heat maps, I thought, what a waste. What a stupid tool. But I really wasn't seeing the value of this thing. If you don't like watch lists, or you find that they're too hard to read, like me, I'm running 6 screens on 2 computers on a 8-foot by 6-foot desk. My office is huge. My desk is huge. Trying to squint at some watch lists gets a little tedious through the day, but to just look at this at a glance, you see what's going on. The size of the box implies the market cap in relation to the names around it. So you can see the big dogs, they're the big box. We're mildly bearish this morning. All right, NASDAQ 100, which does not have financials in it, is the major difference between the S&P and the NASDAQ. Microsoft and NVIDIA versus Google and Apple, with Tesla and Amazon sitting on the side. If we're going to get some movement today, up or down, top side breakout, bottom side breakout, we need everything to start working together. If we stay divergent like this, we're very likely going to stay choppy in the market sideways. We might wick through the top, or we might reach those lows, but breaking out above or below and actually extending into a new leg, not with this kind of divergence. So one of the things you want to look for today is a high correlation coefficient. You want to see that all the names start doing the same thing. On Thinkorswim, that's not really a hard thing to do. You can go to the Visualize tab and get rid of this heat map by choosing the index watch. Now you can put your own watch list in there, which is pretty cool. And you can detach these things, so you don't have to actually stay on this page. And they take up a very small footprint. When it comes to the watch list, it has all of them in there. So S&P 100 and the NASDAQ 100. And of course, you can do the Russell, the Dow, the New York Stock Exchange. You can even create your own little monsters of tech list and see how much capital is moving and how many of those names are up versus how many of those names are down. This is an advanced decline line, basically, but it's more advanced because it shows how much money is moving. This is a lot of times where I find divergence in the market before you actually see it come through, right? We'll have like a rising S&P, and yet there'll be more names going down than up and more money going out than in. And then the next thing you know, the S&P flips over and starts going lower, for an example. So a high correlation coefficient, you want to see it, the names above 95%, right? It's 100 names, so you can just use percentage at the end of your sentence. If 7 names are going down, then 7% are going down, or 93% are going up. It really is that simple. Look for that high correlation coefficient. Otherwise, watch for an either or situation. So what we've seen a lot lately is finance or tech will start doing something. If it's tech versus finance, we're going to have a choppy day. We could grind higher in a difficult grind, or we could grind lower. Those days suck. So if these two are divergent from each other, then it's an either or situation. We want to see them working together. These are the 2 out of the 3 risk on sectors: consumer discretionary, finance, technology. Now, technically, I'm not looking at technology. I'm looking at the FANG names. And when it comes to finance, looking at KRE. Right, so it's regional banks for me, and the monsters of tech. If you did want to do it, quote, the right way, it would be XLK on the one side and XLF on the other side. I think it's just going to be a pretty rough, choppy day, honestly, unless we get a narrative that comes out and sticks. So that's what I would be looking for today. That's what I've got for you guys too. Be careful, be safe, watch the news, look for that narrative to come through, to bleed in. And other than that, the goal is just to make it through the rest of the week.